All right. Hello, everybody. It is Wednesday night. So Leon and I are coming to you live from Investing in Education Academy. So as always, want to say thank you to everyone out there who has, continued to share the podcast link. Additionally, to our new members, welcome. We've been having some amazing conversations in our IEA Crypto Bulls platform about cryptocurrency and in the IEA platform itself for our hot seat. It was a really good hot seat. So I'm biased, of course, but it was a good hot seat. And we've learned that some of you all have essentially mimicked some of the investments that you saw inside of the investment account from that last hot seat. So for everybody who's done that and actually seen a return since, using that information for a positive reason, congratulations. For everybody who's thinking, what is the hot seat? You need to become an IEA member. So we're going to dive into the topic today. While we do that, as always, I'm going to do a little bit of housekeeping, and Leon will tell you the topic and why we chose it.
Yeah, so the top, so last week we did, we covered TVL, total value lock. And it's basically a metric for a way to judge cryptocurrencies. It's not perfect. It's not the end all be all, but it's a way to kind of help filter out some of the other coins and projects that you're looking at. And just kind of a way to whittle things down and, just give some insight into the cryptocurrency. In the stock world, this type of thing would be called fundamental analysis, where you're looking at spreadsheets and profit losses, things like that. Of course, crypto doesn't have that. So we have to look at things kind of like metadata around crypto. And one of them is total value lock. So if you didn't see that last week inside the platform, just go to IEA TV and you'll see it pop up, or just search TVL. TVL, yeah. And then if you're outside of our platform, just go to YouTube. But today we're covering something, a metric that pertains to stocks, right? So one of the biggest questions we always get, and and for me, I don't know about Brent, but I know for me, I'm always looking for okay, what's the best metric, data point, information I can get to help me whittle down these over 7,000 stocks to then help me, come to a good choice. I have a ton that I look through that I kind of automated for myself, but I'm always looking for new things that can help me out. One of the ones that I use is called current ratio, and today we're going to cover what current ratio is. So the topic of today is how the current ratio metric can help you pick higher quality stocks. And Brent, you can throw up slide one when you get a chance. Yeah, perfect. So current ratio, right? So one of the biggest things when you're investing in companies, in stocks, and then of course stocks are part of companies, one of the worst things that a company can have is huge amounts of debt, right? Accounts that have companies that are highly leveraged are very, very dangerous. Reason being is if all their profits are going to paying down debt, that money therefore is not being reinvested into the company to improve products, hire new people, maybe issue a dividend. And then if they, if their revenues then can't cover those debts over the long term, a lot of times they have to file for bankruptcy and maybe go out of business or liquidation. So companies that have high debt are typically very dangerous. And depending on the industry, because some industries by default they just carry high debt because they're just high debt businesses. But generally, companies that have high debt, their stocks don't do as well because investors are worried about, this thing could possibly implode if they can't service their debt. So what current ratio covers, it tells you, and it's simple, right? None of us are trying to sit around here and go through a company's balance sheet and look at their assets and their liabilities. Current ratio is a quick way to assess that. And so Brent has the slide. We're going to cover these 5 bullet points and just kind of explain what current ratio is. So current ratio.
Real quick.
Oh, sorry.
Before you dive fully into that, I hope you really paid attention to what Leon was saying about the debt side of business. Often we don't look at the company's financials, and Leon, I will give him complete and utter credit on this. He always checks companies' financials, and it's still there's different types of people who invest in the world, but it actually behooves you to do that because you could be in a company receiving dividend payouts, or you could be in a company where it seems like they're growing because they have money to operate, but we don't realize it's leverage money. They have money to pay their dividend, but we don't realize it's leverage money. And then the reality is some of us don't even truly know what leverage money means. And it just means that, again, what Leon said earlier, they borrowed money to actually provide all these services. So it's kind of a smoke and mirror situation. You really want to look at this. This ratio is actually pretty important. So if anybody's watching and you have questions, drop it into the chat below. You may have questions on this one. We will absolutely try to answer what we can. And for those of you all who are listening to the podcast, you can leave comments on the podcast, or if you're watching on YouTube, you can leave comments in the section below, and we'll try to get to you as soon as we can.
Yeah, and just a real quick story about this kind of topic. So there, for people that may or may not follow the finance like Brent and I do, there's a big situation right now in China. There's a company there called Evergrande. It's the largest real estate company in China. And like Brent was saying, leveraged debt, companies that are highly leveraged. Current ratio measures a company's leverage to assets or debt to assets. Evergrande, so people don't know, Monday, I think it was Monday, the market was down huge. Monday, the market was down huge. A lot of people attributed that to this situation with Evergrande in China. So what happened with Evergrande is they have debt, they have some bonds that are coming due, they have to service that debt. And that's kind of what we're talking about here. They have leveraged money that they now have to pay an interest payment on. And the question was, could they actually make that payment? And if they couldn't, they could default, which then could have huge ripples across China, which then may hit Asia and then the United States. What's called contagion, if it was going to contaminate the rest of the world. So Evergrande in China has huge debt. They're way over leveraged, and they almost got in some trouble Monday. But the bank, the PBOC, the Republic, whatever the China central bank is, I forget the name of it, came in and kind of quote unquote bailed them out. But it speaks to this point of companies that have large amounts of debt are very, very dangerous. And that's what current ratio we're going to talk about today. So what is current ratio? Current ratio measures a company's ability to pay its short-term debts, typically due within 1 year. So we're not talking long-term debt, right? So companies do have long-term debt, which is typically over a year. Current ratio just covers short-term debt, like 1 year or less. Current ratio covers all assets that can be turned into cash in 1 year, and all liabilities that can be that are due within 1 year. So all the bills that are due within 1 year is covered under current ratio, and then all assets that can be turned into cash within 1 year are also covered under a current ratio. Assets and liabilities are reported on a company's balance sheet, right? And none of us, I look at numbers all day. I'm not looking at the company's balance sheet. I use ratios like this to kind of help me out. And what this does, this really helps us avoid having to go and search through all these financial statements, because these ratios are really, really helpful. So current ratio helps us basically do an analysis or analyze a company's balance sheet without having to dig through all the financial paperwork. It's really, really simple.
And Leon, we had a question come up, and the question was, how do we check a company's financials? Well, to answer that question, it depends. There are a number of different ways you can go about checking a company's financials. If you are a stockholder, you should be receiving a prospectus, or you can request a prospectus, and that's going to tell pretty much everything: the financial health, operations, management, everything about the company should be included in there. If you do not have it, and companies don't deliver it like they used to, because most of the things are digital, and there was a period where stocks and so forth were held in street form, and when that happened, you were the sole owner, and long story short, they used to send it to everybody. They do not do that anymore. So you can call the investor relations line if you don't have a prospectus. Most big companies will have an investor relations line. You can call them and ask for the information. But we're in the information age, right? So you can go to Yahoo Finance, put in financials. If you're using a brokerage account, most companies, the only thing you have to do is put in their company in the search bar in your brokerage account and look for financials. I think it says financials. Click it, and it's going to show you a plethora of financials that you can look at. So that's about 3 different ways you can find it. And if you're online, Google it. Everybody,
Yeah, right.
You can Google it, and you want to make sure you're getting the right information though. So number one, if you start searching for financials, try to search for the company by its full name. Don't use a ticker symbol. We've seen a lot of people use ticker symbols when searching, and they end up with the wrong company. And now they're even ended up getting cryptocurrency. And they just keep reading, and they don't pay attention to what they pull. So be careful, and you don't want to pull an ADR or American Depository Receipt, because you might read that, and it might be different numbers if you were to look at the company itself. So just be careful.
Yeah, and like Brett said, on Yahoo Finance, which is probably the easiest way because it's free and it's out there for all of us. Put in the company name. It's going to draw. You're going to get the results of the company, and then at the kind of like in the middle of the page, there are a bunch of links for different things. Click on statistics. When you go to that page, that will show you. Then scroll down. That way you'll see all the ratios. You'll see a bunch of the company's statistics around the company's financials. So Yahoo Finance, put in the stock name, like Brent said, the full name, and then click on statistics, and then you'll be able to see things like ratio. And there are a bunch of other ratios there too. Then once you get to that page and you see some ones you might be interested in, just Google them. Just Google the name of the ratio, and you get some information on them. So second to last, so now we know what current ratio is. Now how do we actually read it, right? So current ratio is basically displayed in it's displayed in whole and / decimal numbers, right? So typically you'll see, so you'll basically you never see this, right? So 1.0 kind of means that a company has equal assets to equal liabilities. That's never really the case. You generally never really see a company with a 1.0 current ratio. Typically it's going to be either above 1.0 or below 1.0. If it's below 1.0, that means the company does not have enough assets to meet its short-term liabilities, which is a bad thing, right? Doesn't mean the company's going out of business. Doesn't mean it's a bad company. It just means currently that its liabilities are larger than its assets. If its current ratio is above 1.0, that means the company does have enough assets to meet its current liability. So below 1.0, quasi bad. Above 1.0, quasi good. Now, I want to make a main point here. What I just said there was idealized, right? Those are like ideal numbers. What you really have to do is you have to worry about what is that particular sector's or industry's current ratio. So an example is, I'll just pull two things out of there. So say we look at the database sector, right? And say you look at MongoDB, which is a database company, and then Oracle, another database company, right? So you may look at MongoDB and see that their current ratio is 0.6, right? You may say, well, Leon, you just said if it's below 1, then they're a bad company. That's not necessarily the case. Like I said, what we presented here was idealized. Certain sectors and industries have their own kind of natural current ratio. So in this example, now this is just, I'm just pulling this out the air. I'm not saying this is how it is, but in this example, those two companies or say the database industry, their current ratios are typically below 1, right? So that means a lot of times these companies have a lot of debt. Again, doesn't mean it's bad. It's just the nature of the beast. So if a company has, say MongoDB's current ratio is 0.6 and Oracle's current ratio is 0.9, in that scenario, Oracle is a better investment because that means it has more assets relative to its liabilities. It's still below 1, but like I said, in this example, in the world of database, that's kind of naturally how their current ratios are. You'll see other, like I was on, like before I came on here just now, I was looking up Microsoft. Its current ratio is, I think it's 5 point something or another. I mean, way above 1, right? Because we're talking about Microsoft, one of the biggest companies in the world. They have cash, from here to the end of the earth. So again, but if I look at similar companies to Microsoft, I'd probably see the same thing. Their current ratios are probably 3, 4s, 5s, maybe 2s, but it's probably unlikely we would see current ratios under 1 for an industry that Microsoft is in. And if it is, if it's a peer of Microsoft and their current ratio is under 1, then that's the company you do not want to look at. You want to look at the ones that are above. They're closer to 3, 4, and 5. So the current ratio is relative to the industry. It's relative to the industry. What we showed here was just idealized. It was kind of an example saying that above 1, below 1. But you definitely want to look at the company's peers to see what the natural current ratio is.
Yeah, I was going to just throw in too, when you're looking at newcomers into an industry, I mean, almost by default, but I'll just say normally they're going to have much higher leverage, much more debt. So not only, look at the current ratio, but kind of think about how long that company's been in existence. Again, Microsoft is the big boy in the room. So, I mean, and then when you get into like Fame, they're going to have current ratios that are.
Oh, explain Fame.
Oh, so for anybody that doesn't know, there's a group of stocks that they kind of put together. It's Facebook, Amazon, what was the N? Netflix and Google. And so they're called the Fame stocks. So yeah, so good call, Leon. So when you look at more established, bigger companies, kind of give some grace to the newcomers to the industry. And that's really important to know.
Right. So I'm just doing something real quick. Okay, so so I was just looking for an example. So, like I said, when I looked at Microsoft earlier, Microsoft's current ratio is 5 point something, right? Now I'm looking at Exxon. Exxon's current ratio right now is 0.85, so it's below 1, right? Yeah, that doesn't mean Exxon's a bad company, but that just tells me that most companies in the oil services industry probably have low current ratios, because why? These are companies that have to invest in oil rigs and in pipelines, so it's a huge capital expense. So they're probably highly leveraged. Again, doesn't mean they're bad. It just means that's the nature of the industry. But if you're looking for now, I will say that again, everything's relative, right? So if you're looking at software's current ratios will probably always be really, really high because they're not highly leveraged. They can deal with a lot of cash. They're not investing a lot in equipment. Whereas something like oil services is investing in tons of equipment, construction, pipelines, oil rigs, things like that. So comparatively between those industries, software looks like a way better investment relative to comparing the current ratios of software to oil services. But again, 0.85 for Exxon isn't necessarily bad because its peers probably have roughly the same type of current ratios. So again, when you're doing this comparison, don't look at everything as like, oh, it's below 1, it's bad. Look at the company's peers and then see what they're like. And you kind of understand the natural current ratio for an industry.
Yep. And so that being said, but did you have anything else, Leon?
Just that. So I would hope that everyone starts using current ratio. Remember that it's comparative, right? So don't look at it in a vacuum. Look at it compared to the stocks in the same industry as a stock you're looking at, and that'll kind of tell you. And also, it's comparative to the same industry. Like I said, don't use current ratio to compare apples to oranges. Don't use Exxon's current ratio to compare that to Target. That doesn't work. You have to compare it to the same industry.
That's something to really consider when you're doing it. And I saw the comment come up about Apple. I'm pretty sure Apple's current ratio is going to be, let me guess, 6.5.
I look it up right now. It is, yeah.
Where's the drum roll?
This is right. Apple's is current.
So this has me on suspense because I'm thinking, am I right? Am I wrong?
Nah. You're way off. Apple's current ratio is 1.06. So
they're the biggest company in the world. But that also goes back to, you got to think about all the industries Apple's in, all the countries they're in. And I mean, really, they probably have a lot more human capital that they have to invest in. So, I mean, it's still the biggest company in the world. It's still the biggest company in the world.
Yeah. I mean, and looking at, if you compare Apple, because remember, Apple, so a lot of people think of Apple as a technology company. It's not. Apple is actually a consumer electronics company. Their business is making product like hardware, which costs money. Whereas Microsoft, their whole thing is digital, right? They're not making, well, they were one time, but they're not making phones or computers like Apple is. Apple is a hardware consumer electronics company, which takes a lot more invested capital versus something like Microsoft that just makes digital products. So that makes total sense to me that Apple's current ratio is 1.06 and Microsoft is like 5 something.
Yeah, and actually, I just got a statement. It wasn't them asking about Apple. It was to let me know I missed the second A in fame. So, so Apple. So Facebook, Apple, Amazon, Netflix, and Google. Yeah.
Right.
Cool. Appreciate it. Thank you. So, I mean, with that being said, today, really, again, the conversation we had recently with the crypto bulls, fantastic. We actually got an alert for some more free cryptocurrency. So, if you're not in this game, you really should get in it. Also, we had a couple new people start mining inside the IAA platform. We just listed 2 IPOs that dropped, and they're ones that you should be watching. So if you are an IAA member, please go to the platform, check out that notice on the 2 IPOs that just hit, and just keep an eye on it. See, again, Leon and I normally don't buy into IPOs, but these are companies we definitely think you should be watching. Let me see. I think that's pretty much everything for today. If you are considering becoming an IAA crypto bull or a Panther, if the Panthers are working on a deal right now to buy some beachfront property in another country, and it's super exciting. If you have interest in something like that, let us know, because for the Panthers, I want to say there's only 4
Yeah, 3 or 4. Yes,
There's
not
like
much.
3 or 4 more slots left. And with this land acquisition, this is going to be pretty big for us. So we're really excited. We'll give you more information as it gets closer. But yeah. And if that deal closes, we're going to go into the deal already having equity in the property. So that's also a huge bonus. Did I miss anything, Leon?
No, that was it. Just everybody, like I said, our number one question we always get: what do y'all look for when you're buying stocks and/or crypto? If you didn't check last week's podcast, check it out. We covered TVL, total value lock, helps you kind of whittle down your cryptocurrencies. Today we cover current ratio for stocks, can help you kind of mine down and weed out some of the less quality stocks to find higher quality stocks. So definitely check those 2 videos and start using some of these tools to really kind of help yourself pick up higher quality stocks and crypto.
Yeah, and last piece that I'm going to just throw out a teaser. We are back to working on bringing a new investment category to IEA that will be available to our members once we figure out everything. But just know this, we're working on expanding IEA. We talk about stocks, we talk about entrepreneurship, we talk about cryptocurrency and real estate. Now, with life insurance and some other things, we're starting to find experts in some of these fields that can come in and actually educate our community. So we're working on another field. Hopefully that'll be worked out by January. Yep. So that's everything for us. We are going to put our stock picks into the Facebook group. So if you want to go to Facebook and search Investing Education Academy, one of our stock picks will be there. If you are already a member of Investing Education Academy, just go to the platform and you'll be able to find both of the stock picks. So we're putting both of them in there, right, Lee?
Yeah, so put one into the Facebook group tonight, and then tomorrow morning we'll have both picks on the membership platform.
People are asking, what is the field? That's why it's called a teaser.
That's called a teaser.
Yeah, it's a teaser for a reason. But I will say this: it's definitely something people have been asking about. And when we talk to the person that might be heading the position, like this year alone, he's probably done a little. Well, you know what? I'll leave that off the table. But he's done well. He's done well, and the information he has is top notch. So, however we figure it out, we may be more people coming into our ecosystem to teach and to educate us. So we're growing, and we're happy to do all the supporting us along that.
And not only just to teach and educate, but also to bring us investment opportunities and investment deals. So like the deal Brent talked about, the beachfront property we're working on. That's just one type of deal. The new category we'll bring up, this individual will be able to bring us actual investment opportunities. So yeah, it's exciting stuff.
Yeah, and we have people now contacting us about 9-unit apartment buildings, 12-unit apartment buildings, and the opportunities are starting to come a lot faster. Businesses, they're asking us to provide startup capital to our investment group inside of IEA. So it's a lot of things now, and that's in addition to the private equity deals that we've been investing in now for about a year. So yeah, so it's a lot of really great stuff happening, and we hope that you can be a part of it. If you have questions, feel free to reach out to myself, Brent Simpson, or Leon Noble, and we'd be happy to answer any questions that you have. Everybody, thank you for being with us. We will see you all next Wednesday.